The Social Security tax torpedo. This is a big deal, man. This is a big deal. Working with a guy this morning, a client from New Jersey, about 58, 59, something like that. He's going to retire in a few years, and we crunched the numbers, and he could easily retire today if he wanted to. Single guy. Anyway, his point was he was thinking about taking Social Security early. And I said you should take it at full retirement age and start withdrawing from your 401k accounts. Try to get that sucker withdrawn as much as you possibly can before Social Security kicks in. Lots of different reasons to do this. I'm not getting into that. I want to just share with you what a tax torpedo was. And that was his default right capital to take at 62. And I said, no, don't do that. What happens is a few years back, I don't know, maybe 10 years or so ago, no one really knew about the tax torpedo. They just didn't. Slowly but surely, has been getting the vernacular. Bill Reichenstein over at Baylor, I think he's still at Baylor, has written articles about it in the last 5 years or so. But a lot of people are still ignorant of it. Now, John Larson, the congressman, I think from PA, Pennsylvania, I think, the Social Security 2100 Act, and I think that was a previous Congress. I'm not sure if it's been reintroduced for this Congress. I don't know. That would arrange to get rid of the tax torpedo, which I'm a huge fan of. Not necessarily the bill and all of its caveats, but that one thing, because the tax torpedo is freaking ugly, man. And I can almost assure you don't know about it. All right, so in this case, what happens is, and I'll show you a graphic representation of that here in just a second. All right, so your Social Security typically is taxed. Only 85% of your Social Security benefits are taxed. Usually for people who have decent-sized IRAs and other sources of income. They know that most likely 85% of their Social Security is taxed. What if you don't have that much in IRAs, all right? Well, in that case, some of your Social Security might not be taxed, a good amount. Some people, they might not have any Social Security tax. So it goes from, basically what happens is it goes from zero tax, and then very quickly it jumps to 85% tax. And what literally happens here is once you are in the torpedo zone, every dollar of income you adds $1.85 of taxable income. Even though you're only adding $1, you have to show in your AGI $1.85. You're basically being double taxed on the same dollar. It's crazy. So let's show you a visual of this. It's nuts, man. And I was playing around with Right Capital and I was having a hard time actually visualizing this. So I said, I would just find an article. And this seemed pretty good. I don't know. This was written in 2015. That's 6 years ago. So a lot of people weren't talking about the tax torpedo back then, so kudos to him. All right, so the Social Security tax torpedo is a name for the phenomenon that occurs when a Social Security recipient has income from other sources, resulting in some of the Social Security being taxed. The tax torpedo often strikes people as they reach required minimum distributions. It was in the the implementation of this effect is complex. Yep, the various explanations I found on the internet were sensationalist, overly complex, or difficult to understand. So this guy's going to give us some visuals. This doesn't help me at all. This makes my head I want to drop an anvil on my head. But this right here, all right, right here, I want to show you. So we're going to come back. I want to show you this graph. Here's exactly how it works. Non-Social Security income from median income level, 25. This is 2015 now. $25,000 for non-Social Security. If you're married, filing jointly, you have $25,000 of IRA distributions. Notice, none of your Social Security is taxed. None, because of the way the provisional income rules work. All right, so look at that, none. Now, what happens if you add $20,000 to the mix? 85% of your Social Security is taxed. So if you add $20,000 of income, now you're at 40 to 45,000. You went from zero taxation of your Social Security benefits to 85% being taxed, which means for every dollar right here, $1.85 is added to your AGI. So let's read what his saying here. In the median income case, what if you had $50,000 of income but needed to withdraw $1,000 more from your IRA? Looking at the first 2014 tax curve, you would correctly estimate that $1,000 would be taxed at 15%. Now it's 12%, but what he's doing is showing you right here. And I'm not going to get this, but he's just saying basically that $1,000 would be taxed at whatever your marginal tax rate was. In this case, you're in the second lowest marginal tax rate. But in the case of the Social Security recipient, Instead of being taxed at 15%, the tax was stored at 27.75%. Or in the last chart, with over $100,000 income, an incremental $1,000 could be taxed at 46.25. That is the tax torpedo in action. At low income, Social Security is completely tax-free. But as income increases from other sources, such as dividends, interest, capital gains, even municipal bond interest, the tax-free status is phased out. To determine how much of our Social Security is taxable, we use combined income, the IRS does, or what I call provisional income. This is the sum of all income from other sources plus 50% of your annual Social Security income. Why only 50%? Well, because during our working years, we pay tax on half, and we're paying taxes on 50%, and our employer's paying tax for the other 50% to cover our Social Security tax roll. Vinny, hey. This is where it gets a little weird. Two different thresholds are used to determine the percentage of your Social Security subject to taxation. All right, and so we talk about this. I'm not getting too much real quick, but I just want to show you again. The easiest to understand is in graphic form. The graph uses this median Social Security income of $15,228 per year. You can estimate your own Social Security income here. And he brings it to the quick calculator on socialsecurity.gov. For an early retiree, the likelihood of having most of Social Security tax is low. If it does happen, Social Security income is lower due to many years of not working. Other income is also lower as people live well for less and choose leisure over labor. All right, but if someone who has a high non-Social Security income, those with large pensions, and if RMDs are lost, then up to 85% of Social Security income will be subject to taxation. In this case, this income is added to AGI. So let's think about another way. If you withdraw $1,000 from your IRA, what percentage of it is subject to taxation? 100%. If you earn interest on your savings account, what percentage is subject to taxation? 100%. If you are still working and saving for retirement, what percent of your income is subject to taxation? 100%. But in the worst case, only 85% of your Social Security is subject to taxation. So we know at least at the very minimum, Social Security gives you 15% tax-free. But with marginal tax rates of 27 and 46%, it would be better to pay taxes in our working years. Our marginal rates, he's talking about using a rough tone. All right, but wait, these scary are not actually real. When combined income is greater than the upper base, each additional dollar of non-Social Security income increases taxable income by $1.85. So that's when, for provisional income, they call combined income, is greater than the upper base. And again, the upper base, if you're married filing jointly, is $44,000 for provisional income. If you're single, it's $32,000, right? Yeah, 32. I think it's 32. Is that what it is? I can't remember. It's 32,000. Let's see. I forgot. 32 and 44. That's right. Yep, 32 and 44. All right. So if you're single and you're beyond the $32,000 threshold, each additional dollar of non-Social Security income is taxed. You'll have to pay $1.85 in increasing taxable income. Let me say it again. Each additional dollar of non-Social Security income, if you're single and your provisional income is above $32,000, and if you're married and your provisional income is above $44,000, will increase your taxable income by $1.85. Thus, at the 15% marginal rate, $1.85 equals 27%. So it's a 27.75% increase on that $1 increase in taxes on that $1. But you're not in a 27% bracket. You're only in a 15%. At the 25% marginal rate, you're in a 46.25% bracket, even though you're only in the 25% rate. All that happens is that taxable income is just added to the AGI. The tax rate doesn't change. The amount of income subject to tax does, and that's the distinction worth pointing out. The tax rate doesn't change. It's just increasing subject to income taxes. $1 of extra income for you to spend increases your AGI by $1.85 once you hit the upper thresholds of the limits on Social Security. $32,000 if you're single and $44,000 if you're married. So again, example, we got Social Security is $15,000. You got $5,000 interest, $24,000 qualified dividends, $2,000 non-qualified dividends. Total income $46,000. Tax due a big fat goose egg. Long-term, okay, gotcha. Despite the dangerous sounding name, the sensationalist articles about exploding marginal tax rates of whopping 85%. Let's see here. It might be a torpedo, but it's made by. No, get it. All right. Anyway, so what I think I've done. That's not the greatest explanation. But let me just show you. This is all that matters right here. Right here. Zero. This is a married filing joint person. They have 25,000 non-Social Security income. None of their Social Security is taxed. None. They get 45,000, is about 42,000 of income. So they increase their income from 25 to 42. That's $17,000. Now 85% of their Social Security is taxed. Isn't that right, big boy? That's a tax torpedo. The point being, draw down your IRA before you take Social Security. I'm telling you, the more you draw that puppy down, the less taxes you're going to have to pay once Social Security kicks in. Because once Social Security kicks in, you're going to be paying tax on Social Security plus your IRA. And if we could just have you live on Social Security with minimal distributions from your IRA, that's tax-free. A lot going in there. You got to do your research on the tax torpedo. I'm probably not giving the short shift, but read up on it because it's huge and it's critical to know how it works. All right, we'll see you.